We will now pick up with tonight's session by discussing the remainder of Chapter 3. There's just a couple items that I want to go over in Chapter 3, which are not real important in the whole scheme of things, but I think they're important for you to see the whole picture. Alright, we'll see here with Learning Objective 4 and 5, I just want you to understand the flow of cost in a job order costing system. I'm not going to have you prepare journal entries, but I just want you to understand that in a manufacturing environment, the costs, the way the item is manufactured, the accounting pretty much follows that. So, for instance, there's some definitions of some things we need to understand. Number one, raw materials are the materials that go into the final product. It's the plastic, the metal, all of those items. Once an item is put on the production floor, it becomes work in process. And in other words, units of production that are partially completed, they have labor, they have materials, they have some overhead added, but they're not complete, are considered work in process. Once the item is completed, it becomes what's called a finished good. Completed units of product that have not been sold to the customers. And finally, the last key definition is cost of goods manufactured includes all the manufacturing cost associated with the goods that were finished during the period. As you can see here, a flow of costs. If you see all the costs, we're familiar with materials, labor, and overhead. You'll notice by this chart that materials obviously are considered an inventory item. They're considered raw materials. Once they're put on the floor, they become work in process. Labor gets added to the materials, and so does overhead, such as utilities, depreciation, insurance, all that sort of manufacturing indirect cost. So materials move from the inventory account, raw materials, into the inventory account titled work in process, and labor, overhead are added to that work in process inventory account. Finally, when the item is completed, it goes to finished goods, another inventory account. So in a manufacturing environment, a company will have three inventory accounts: raw materials, work in process, and finished goods. The item that is completed and not yet sold is considered finished goods. Once the item is sold, then it becomes cost of goods sold, which is on the income statement. So finished goods move to cost of goods sold, therefore you decrease the inventory on the balance sheet, increase the expense on the income statement. I just wanted you to understand that sort of stuff. I'm not going to go through all the T accounts and the journal entries. I don't believe that is necessary. The last item that I wanted to discuss in Chapter 3 deals with overhead application. We went through and applied overhead on one particular job based on an estimated predetermined overhead rate. And that is done for all jobs during the year. Okay. Finally, at the end of the year, we need to take a look at, okay, how have we applied overhead during the year to all of the jobs? Have we applied all of the overhead necessary, and maybe we've over-applied, we've applied too much overhead to jobs, or possibly we haven't applied enough overhead to jobs. And this can be a function of a couple things. Number one, our predetermined overhead rate was understated or overstated, or the amount of direct labor hours or machine hours, whatever the driver was for the application of that overhead, maybe that the actual number of hours of labor or machine hours was too much or too little, and therefore we applied too much or too little overhead to all of our jobs. So I just really want to discuss this concept. Alright, so the difference between overhead cost applied to work in process and the actual overhead cost of a period is referred to as either over-applied or under-applied overhead. If you look at the definition here of under-applied overhead, it exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. What you need to remember is that all throughout the year, we're using this estimated predetermined overhead rate. And finally, at year end, we need to settle up and we need to reconcile the estimate compared to the actual. Applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. Let's look at an example. Paraco's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. How much total overhead was applied to Paraco's jobs during the year? Using Paraco's predetermined overhead rate of $4 per direct labor hour, they would have applied $680,000 of overhead, because there was actually 170,000 direct labor hours. At $4 per direct labor hour, they would have applied $680,000 of overhead to jobs. But in reality, there was only $650,000. So in effect, we over-applied manufacturing overhead for the period. Okay, so Paraco has over-applied overhead for the year by $30,000. The question is, what will Paraco do? Paraco will actually make a journal entry, all right, to take care of this. Okay, looking something like this. All right. If I was to go back, had the overhead been actually 150,000, I'm sorry, had the direct labor hours been 150,000 during the year, we would have applied $600,000 of overhead to all jobs. But we incurred actually $650,000 of overhead. In this instance, we would be underapplied by $50,000. We would have been underapplied by $50,000. All right, because this would have been 600 versus the 650. That would be $50,000 underapplied. To illustrate our discussion of computing under-applied and over-applied overhead, let's go back to exercise 3-12, which you did for homework for this week's class. If we look at exercise 3-12 on page 117, we go back to Cody Corporation, who used a job order costing system with a plant-wide overhead rate based on machine hours. At the beginning of the year, the company made some estimates. We went through in parts 1 and 2, and in part 1 we determined that the predetermined overhead rate was $9 per machine hour. We figured out in part 2 that the total manufacturing overhead cost was $850. In part 3, we're asked to during the year, the company worked a total of 147,000 machine hours on all jobs and incurred actual manufacturing overhead cost of $1,325,000. They ask us, what is the amount of underapplied or overapplied overhead for the year? If this amount were closed out entirely to cost of goods sold, would the journal entry increase or decrease net operating income? I'm not so concerned as much about that. So if we were to look here at this situation, we would figure out, okay, that the actual manufacturing overhead was $1,325,000. All right, $1,325,000 as given in the book. The actual overhead that would have been applied would have been the 147,000 machine hours multiplied by $9 of a predetermined overhead rate to give you $1,323,000 of manufacturing overhead applied. This manufacturing overhead applied of $1,323,000 compared to the actual manufacturing overhead of $1,325,000, we would have underapplied overhead for the year by $2,000. Why underapplied? Because for all of the jobs we would have added $9 for every machine hour. We only had 147,000. We expected to have 150,000. Therefore, we did not apply enough overhead to our particular jobs. We were under by $2,000. This does it for our solution to exercise 3-12, and this wraps up our discussion of Chapter 3.